resources and support for Aboriginal businesses and the sector. So I'd encourage all of our members who are yet to complete the survey to jump on and fill it out. And more importantly, you'll also receive $220 worth of gifts for completing the survey, which include a $100 Naked Wines voucher, a gift from Indigenous Business Australia, some chocolate bars from Kinaway member Jala Jala Treats, a personalised Kinaway notebook, as well as entry into a draw to win even more prizes. There's plenty in the survey for all, for us here at Kinaway, then also our members as well who fill them out. So please jump on and complete when you get the chance. I'd like to also take this opportunity to make member businesses aware of the Victorian Government First Peoples COVID-19 Business Support Fund, designed to support Victorian Aboriginal businesses that have been affected by trading restrictions. These grants can be used to help meet business costs, including rent and salaries, develop marketing activities, or pivot the business's offering in response to the current economic environment. Eligible businesses will be provided with a one-off grant of up to $10,000. Please note there is a criteria for eligibility. So again, please jump on the Kinaway website to find out more information. I'd like to also mention the confidential phone crisis line for the Victorian Aboriginal and Torres Strait Islander people launched by the Victorian Aboriginal Health Service. The service is for Indigenous people and families who feel they may need to have a yarn with someone about their wellbeing. This 1-800 helpline is a statewide social and emotional wellbeing service. The helpline, whose number is 1-800 95 9563, operates 7 days a week from 12 p.m. to 10 p.m. and you'll find their contact information on the screen throughout today's webinar. And finally, there are plenty of webinars on various topics available on our Facebook and YouTube channels, so please feel free to jump on at any stage and make yourself familiar with the content. Along with the webinars and support packages mentioned, Kinaway is still offering the usual forms of business support for our members. So if you feel you may need assistance or support of any kind, please feel free to get in contact with the team here at Kinaway. Now the housekeeping's out of the way. Businesses live and die on their cash flow. Some of the biggest businesses in the world turn small profits or even lose money each year as they seek to rapidly grow. However, if your business runs out of cash, it is prone to be wound up as you fail to pay bills and are unable to secure the inputs for your business's needs. The cash flow support your business needs evolves with your business as it progresses through its business life cycle. There are different sources of funding that are designed to meet different needs. Today, we are pleased to have Adam Fletcher from NAB joining us to help us understand how banks can help businesses to grow, where debt finance fits within the funding mix for a business, some examples of bank loan products available to businesses, and what steps you should consider taking before you apply for a business loan. For those tuning in, please feel free to post any questions or comments on the Kinaway Facebook or YouTube channels, as we'll be answering any questions we may receive throughout after this morning's discussion. We hope you enjoy the webinar, and as always, please don't forget to leave a like, comment, subscribe, and turn on the notifications. And before I introduce today's panelists, I'd just like to note, please be aware the information provided is factual in use only and is not intended to be financial product advice, legal advice, or tax advice, and should not be relied upon as such. The information is general in nature and may omit details that could be significant to your particular circumstances. I'd like to welcome Adam to this morning's webinar. Adam, how are you on, brother?
Good, thank you. How are you?
Good. I'm very well, thank you. I'm very well. Thank you for joining us for this morning's webinar. Something that Kinaway really appreciates, and I'm sure our members appreciate also.
I just want to be clear, you guys can see me okay? You can hear everything?
Yeah, all good, mate, all good.
Excellent, mate. Thank you very much for having me today. I'd just like to start also by acknowledging the traditional owners of the country that we're all meeting together on, acknowledge elders past, present and emerging, and also I'd like to acknowledge that sovereignty was never ceded.
Great, thanks, Adam. Before we get things underway today, can you tell us a little bit more about yourself, and your role at NAB?
Definitely. My name's Adam Fletcher. I'm a green guy, Wanneroo fella. So I'm a Hunter Valley, New South Wales black fella. Been living down in Melbourne for just over 11 years. I moved down for a graduate role with National Australia Bank. And my current role now is the Associate Director for Indigenous Finance. So my focus is squarely on, the business needs of your membership. So I'm definitely keen to connect and understand how banks and other finance service providers could be responding and meeting the needs of Indigenous businesses. It's kind of a two-way street. So I do also a bit of business development work directly with clients, I refer businesses across to some of our banking specialists. And I also help internally within NAB understand the opportunities of the Indigenous business sector. It's rapidly developing. There are programs available, grants available, and there's procurement opportunities and things like that. And internally, it can take a bit of time for some of these large organisations to understand those opportunities. So my job's to help sort of fast track that understanding and hopefully get the best outcome for customers when they're applying for finance with us.
Absolutely. Thanks, Adam. So we'll get things underway and we'll on today's topic. I'll touch on the role of banks in the business funding mix. Where do banks fit into the mix of funding to support Indigenous business growth?
So banks are probably one of the key pillars of business finance for most organisations. I'm sure you guys have covered some of the sort of high-level financial and accounting concepts in some of your previous webinars, and I'm sure there'll be future series on things like this as well. But basically, after owner's equity has been established within the business, so the initial cash that you've been able to tip in yourself as the initial business owner, as well as other equity sources that you might be tapping into. So you might have business partners, potentially joint venture partners. That initial capitalization is usually done by the owners. And those owners are the ones that usually share the benefit of the business. And you guys have long-term ownership of the business until you either choose to sell it down or to wind that business up. And it cannot sometimes be the most expensive form of capital, but it can also be some of the cheapest and most patient forms of capital. So that initial capital establishment, the initial funds that you use to establish your businesses, it could be your own cash, it could be grants from the government. There's a whole bunch of sources. Once you've got that up and running and you've got a bit of operating history, that's when the role of debt can come into play. Banks predominantly are regulated to only provide debt financial products. And the difference between debt and equity is that debt takes priority. So when you're looking to repay the various aspects of running your business, debt is one of those functions or one of those elements you need to consider payment first of. It's just like paying your bills to your creditors or your suppliers. The loan can be for a fixed term, so we might structure a loan that is payable over time. It may have principal and interest components, but basically we don't take an ownership structure, an ownership stake in your business. And legal precedence means that we take a priority over other contributors to the business. So in the event something goes wrong, we usually get the first right to kind of cover our potential losses from the business. Then that's when the equity holders, the owners, then get to kind of take up whatever's left over at the end of the day. So yeah, we're a little bit different to an owner in the fact that we try really hard to minimize the exposure that we have in the event that something goes wrong with the business. And we work really closely with business owners to understand what their goals and objectives are, so we can align the various products and services we offer to you to meet those needs and in alignment with sort of those growth aspirations.
Absolutely. Thanks, Adam. I know you touched on grants while you were answering the previous question.
Yep.
So where do they fit into the funding mix?
So grants are when we're looking at when we're initially assessing the business for a loan product, we're really looking at like your cash flow forecasts and your revenue forecasts, and we're looking at the asset base and the equity that's already inside the business. So we're looking at to see that there's a good safe buffer for the business that's within the business within your balance sheet before we start factoring in how debt can contribute to that liquidity base. So grants can be a great way to initially sort of maybe purchase some capital assets you might be looking to buy, like if you're starting or to purchase some initial amount of stock. It can be a great way to initially prove out the concept of your business. So a lot of business owners come up with a really well-defined business plan, but no demonstrated experience on how to do it. So if you can apply for a grant, it might allow you to kind of do like a small experiment, or in marketing terms, they talk about minimum viable products. So a small version of that that final service that you're aiming to provide, you can prove that you can actually do it, and you can prove that you've got a market for it, and then that provides additional support for your forecasting assumptions that you might be putting in your projections in your business plan. So that's a great role for it. And once the cash is inside your business, it's part of that overall initial capital funding mix that we look at. So as long as there's a good buffer there, that gives us some comfort that your business is ready to start looking at drawing down some additional debt, perhaps to purchase, a ute or something like that, or some additional capital equipment that might support that next stage of growth for your business.
Sure. And when banks start providing debt to businesses, can they lend money from day one?
In some ways we can. So most banks will have, so basically when you first establish your business, you should definitely look at establishing a transactional account in the business's name. That's kind of your gateway to the banking system. And it means that if you need to apply for a loan or for funding in a hurry, the bank's already aware of you. They've already got a lot of your details. It'll just fast track a lot of those things. And if you combine that with linking it into some great accounting software, a lot of the loan application details will actually be provided from that software. The other benefit of the transaction account, there's a product like an overdraft facility that can be attached to those, and that can be activated pretty soon after the establishment of the business. Perhaps not day one, but that's part of that initial account setup that you can look at, and so you can kind of make a case for how much additional cash flow support you might need in that initial phase, and that's a conversation you can have with your banker, or it's something you can factor into that initial application process. There's also other products that you can apply for pretty soon after establishment. There's business credit cards that are very similar to personal credit cards. And again, they'll be assessed on the strength of your cash flow and some of the projections of your business. Those are fairly light touch products because they've got relatively low limits and stuff like that. And the intention is that you would repay those every month. But those can be those initial products you might look at exploring when you're first setting it up. And there are other facilities too. If you've got personal assets and you're personally establishing your business, you can look at using personal assets like your house as security overall for the business. But that's probably not something you look at doing from day one. That's probably something you're going to assess as you start that sort of first stage of growth once you've got everything up and running.
Sure. And I know you touched on those sorts of transactional accounts, such as the credit cards or overdraft sort of facilities. Are there any other sorts of accounts that businesses can or should look to open up when accessing any sorts of business loans?
Yeah, so one thing I'd strongly encourage is having a yarn with your banker when you're looking at making any kind of strategic shift for your business. So you should have a group of trusted advisors that you have around your business. And if you're a small business, it could be that you might be calling a contact center. You might need to retell your story a little bit to them, or you might have a branch person that you might be able to talk to, or you may have a relationship banker that you've got contact with. But sounding out sort of what your plans are and what you're looking to achieve when you're making those kind of decisions can be a great way to get started. The types of products you might look at. So there's kind of two broad categories of lending products. There's sort of a secured product, which is what I alluded to before, where you might have some personal assets that you might be willing to put up as security for the loan. And that provides additional comfort to the institution that, if something goes wrong, that there's coverage of the loan commitments. You can also secure your lending with assets of the business itself. So if you've already got stock on hand, if you've already got some plant and equipment inside the business, and so that the institution can hold a charge over those business, or it can also hold a charge over the overall business. We can kind of have like a general charge over the whole business, and that can be used to kind of provide some comfort that if something's going wrong in the business, that the financial institution has some coverage, and that will generally mean that you'll pay a lower interest rate because it's less risky for us to lend overall. On the other side of the fence, you've kind of got the unsecured products. So that's more aligned with like the credit card facility as an initial product. But there's also cash flow finance products. NAB's got one called QuickBiz. There are other products on the market as well. And those are the ones I was talking about, where if you've actually got your account set up with a cloud accounting software like Xero or MYOB, those can be connected in. And basically the accounting software is constantly feeding information about how you're going, collecting debts, how your revenue, your cost base is going, and it can dynamically provide you with an operating limit. It will tell you about what those limits are, and those things are elements you can factor into your sort of financial projections over the course of the year. So that's quite interesting, and it's quite a rapid product in terms of approval, because a lot of the steps that can slow down a loan application have already been taken care of. We already know who you are because you've already got your transaction accounts with us. We've already got quite a lot of details about your financial plan and your progress from the accounting software. So there's just some additional questions that might need to be answered. And that's quite a flexible product that's available as well. And you've still then got things like overdraft facilities. You can negotiate limits for certain things. If you've got like a large customer, so like a government customer, or really, someone who's got a big presence in terms of on the market, and a good reputation, there's a product called invoice factoring or invoice finance, which is where you can basically sell that invoice from that customer that you're waiting for them to pay to an institution. They'll pay you like 80% of the face value of that invoice, and then collect that later on, which then can free up some cash for business to trade. So this is why I was mentioning before, it's really important you talk to your banker about what type of business you're in, what industry you're in, what your customers are like, because these different products will suit different businesses, and they'll also suit different businesses at different times in their life cycle.
Sure. And it's nice that you spoke about, speaking to your banker about, ensuring that you're able to access some sort of finance, which kind of takes me on to the next question. What other things can business owners do to improve their chances of securing a bank loan?
I think engaging as soon as possible is a really great step. I know my dad, he was a small business owner. He was made redundant in Newcastle in 1998, and he sort of started his own cultural business. And he had a really mixed record in terms of engaging with banks. And that was probably one of the reasons I want to get involved in the industry, is to kind of try and bridge that gap between our community and some of these large institutions that we're really reliant on. But if you can find a good banker that you trust, or even just an institution, or where you can get some good advisors providing you advice, the more information we have about your business, and we can kind of sound things out with you. So from day one of establishment, it's worth engaging with a banker, talking about what you're trying to do. We might not be able to lend to you in that immediate moment, but those other accounts, those other sort of foundational pieces can be established early on. And those can be really handy, and that'll expedite any loan application process, because we'll already know a lot about you. You won't have to repeat the information to us, ideally, and that's really good to do. The hygiene, the business hygiene stuff is great. So I strongly encourage you to look at getting a good bookkeeper on board as soon as you can, and I'm sure some of your members are providing bookkeeping services, and I'd really encourage you to look out for those guys, because when you've got your books in order, it's already put into accounting software. It's just going to make everything so much easier. If you turn up to a bank with a shoebox full of receipts, invoices, and a very high-level Excel spreadsheet of a forecast and accounts, it's really difficult for us to quickly digest and understand what you're working with. So having those kind of foundational pieces in place is really great. And probably the last part is looking at the legal construct of the business. So if you can look at separating the financial affairs of your business from you personally, even if it's a sole trading business, the more you can kind of have them segmented. So sole traders can set up a business transaction account, which is independent to your personal transaction account. You can set up business credit cards, as I mentioned, rather than using a personal credit card. The more you can kind of build up that kind of credit report or credit history of the entity itself, because while we basically assess on an application, we look at the entity, the business. So if it's brand new, it's quite risky to us because it's an unknown variable. If it's been operating and it's been trading and using financial products for a long time, that provides us like a track record, so we can actually understand what it performs like. And then we'll also complement that with your personal information as well. So if you're an owner or a director of that business, that provides us information about how well it's being managed. But the sooner you can set those things up as separate entities and try and manage them independently of each other, that makes it a lot easier as well, because we're not having to unpick it and look at it as a single person who's kind of presenting their personal and business finances in one go.
Absolutely. And what about something about an applicant's sort of character as well? Is that something that is also assessed as well, when people are applying for a business loan?
Yeah, so broadly, banking is about assessing the 5 C's, and there's different ways of framing it. We sort of look at things like the character of the borrower, and it's not necessarily your personality or anything like that. It's about the history and because it's really hard to predict what's going to happen in the future. So we do look at the history of the borrowers, the entity and stuff like that, which I was alluding to before. And that's where some of the subjective stuff can come in too. So I mentioned before not bringing in a shoebox full of files and paperwork. It not only does it smooth over the kind of application process if you've already got everything sorted in some clean accounting software, your accounts are all reconciled and stuff like that. It helps, demonstrate that professionalism and that dedication to the business. And I know it's daunting when you first get it started. My dad used to make me do that for his business, but the sooner you can get someone who can help you out with that sort of stuff, it does really well. If you do have strife in terms of your credit history, it doesn't rule you out. I do want to make that clear. Like, we do have to look at the application as it's presented to us in the day, and that's where having a conversation, ideally, a deep conversation with the bank can come in handy. If you can look at the partners you've got involved. So if you've got, so let's say you might have some strife in your credit history. One, there's support for you to help clean that up. So I'd strongly recommend reaching out to financial counselors, financial advisors who can help you understand your credit record, and if there's any errors, omissions, or issues with that record, they can get that corrected, which will help you along the way in terms of applying for finance. Once you've done that kind of those hygiene factors, you can then, if you're looking at the parties involved in your loan, so if you've got a partner who's providing financial support or who can provide a guarantee or security for your business, that can also help address concerns around that. So I strongly encourage you to just look at try and present the best professional version of your business possible. And yeah, if you do have some personal strife, I don't say that like rules you out of being able to apply for this sort of stuff. You just need to do maybe some additional steps, and there is support out there to help you with it. And perhaps even the chamber can help refer you to some of those service providers as well. The other two, there's two other C's that we look at when we're actually assessing the borrower. So the capacity to repay, that was what I was talking about in terms of having, cash flow projections that show you actually have capacity to make the repayments. So when we're looking at it, we're looking at, have you covered all your costs for your products or services you're providing? Are you doing all your superannuation, your tax? All those things that need to be covered off. And then we're looking for a margin to actually meet the debt repayment obligations. We'll also look at like how much you're borrowing in comparison to the amount of income your business generates. So we don't want you to be overly burdened with debt, because it's a relatively fixed commitment. You can't negotiate or renegotiate debt too easily. There are hardship provisions that can be engaged, but we're not really allowed to count on those up front. We really need to assess you up front as of today and as you're projecting forward, how comfortable are we and how comfortable are you that you're going to be able to meet those obligations? And the last one is capital in terms of the first three. That's that initial equity grant funding contribution, that initial seed of cash that you've got in the business. If you've got a healthy balance of cash, you don't need to use that. It can be in there as security for other lending products, but it just allows us to see that you've got a healthy buffer. So if you bought let's say you bought a premise, or you've bought some plant equipment to help you, make some, you might have baking equipment if you've got a baking business. We want to be comfortable that you're not going to be looking around for cash if it's a bit of a tough period, and you're risking not being able to repay the loan on that equipment. So having a healthy cash buffer helps provide some of that comfort. The last two C's are more about how we kind of improve the overall credit risk of the application. So that looks at collateral and conditions, or sometimes they're called covenants. The collateral is what I was mentioning before. If you've got other parties involved in your venture, they might be able to provide guarantees, which are effectively commitments that if something goes wrong with the business, they'll step in and help meet those obligations. It's really important when you're entering those agreements that those people are fully informed of what that means. So it can slow down the application process, because we have an obligation to make sure they're fully informed, and they may need to seek independent legal advice. You also probably should seek legal advice if you're going down that path, just to make sure it's very clear to everyone what they're committing to, because you don't want to have your business get into strife and you might affect a family member or a community member. That could be a really bad outcome. But and it doesn't have to be permanent. So that commitment might be just during a particular phase of the business. So you can have agreements about how long that guarantee is going to be in place for. The covenants are things like, so if you go for term debt, it's usually more when we're looking at sort of longer term and bigger values of debt. We might have requirements saying, you need to provide your financial reports to us periodically, so quarterly or annually. We might have a right of review. So we might say every 12 months, we'll review the overall performance of the business, make sure that we're still comfortable with the level of debt and everything that's going on. We may have financial ratios we might be looking at. So, cash coverage ratios. So, how well is the cash covering the expense of the business, making sure there's a healthy margin in there. Various ratios we might talk to you about. And again, it depends on the type of business you're doing. We might negotiate specific ratios we're looking for in terms of monitoring the health of your business. If you get into strife again, we'll talk to you about how that sort of stuff works. But those things can actually help improve the overall application, and it may result in you paying less. So you might get a cheaper loan as a result of some of these things, or it may mean that we are able to extend lending to you in a situation where we might not otherwise, because sometimes it's a bit of a line ball call for our credit partners who have to review the application. They might go, it's just inside or outside of risk appetite. And sometimes some of these things that we add to our credit application, they can improve our chances of succeeding. So again, I think having a good conversation with your banker, helping them understand your business. And if you're an Indigenous business, part of my role is to help those bankers understand the specifics of your industry. So I can also step in and help like that. And I'm sure other institutions have a role similar to mine that would play a similar role in assisting the bank to understand your business as well.
Absolutely. And that kind of takes me on to the next question, which I'm sure, you have covered a lot of it, for what you probably just said. Assuming, we have some members right now that are kind of watching this webinar, what can they do to better prepare themselves and their business for the business loan application?
Yeah, I think it was largely covered. So it's those financial hygiene things. So that they're not the exciting things as running a business, but having your accounts as clear as possible. You can have your accounts audited, and some businesses do that. We don't generally require audited accounts, but that can help. Working through your forecasts and probably like stress testing them a little bit as well. So when we're looking at projections, there's a few things we look at. We look at what's happened in the past, and those are really just to kind of give comfort over how believable or those projections are. So if you've started from a really low base and you're projecting really rapid growth, as a business owner, you should be considering, well, is that likely? Is that believable? But as a financier, we are also looking at that believability. Is that truly how it's going to be? And that's where those story components come into it. So you might have a large contract that you've just signed, and therefore, that might suggest you're going to have a big growth moment in your business. So there's making sure the historical records are good so they can be relied upon. The projections are believable, and you can look at stress testing them. So you might say, we've got 5 contracts on the run at the moment. What does the business look like if only 3 of them actually carry through to completion? And if you can show some of that scenario planning, that can actually help you in your conversation with the banker, because that'll actually help them understand that you are looking at different scenarios and you're not just sort of projecting a sunny day scenario. And I guess for everyone on the line today, like you've all got experience recently with COVID-19. No one would have anticipated that. No one would have factored that into their planning. But if you had have included some form of projecting like a risk factor, an unknown risk factor, even if it's just a general downturn, and you were comfortable that your business could operate, that gives you some breathing room. It won't save you. If you've had to shut up shop for months and months on end and there's no support available, that won't help you out. But it buys you breathing time. And I'm sure a lot of your members have got stories where you've been able to pivot, but a critical part of that ability to pivot is having some breathing time. Banks can give some relief because we understand that, when something external like this happens, you might need some support. So we can pause lending and pause repayments. There's a whole bunch of things we can do to assist. But if you've already factored that in, that helps heaps. And if you're building that in at the application phase, which is probably a little bit of a weird way of thinking about it, but if you're building some of that thinking early on, that gives us a great deal of comfort that you've actually thought quite holistically about the business. So yeah, that's probably my advice on that part.
Yeah, it's great. It's great that you mentioned you just have that sort of proactive, kind of approach to the whole application sort of process. And again, for any sort of member businesses that are out there watching and considering, applying for a banking loan,
Yep.
what are the common reasons for taking out a business loan? And also, is there anything sort of specific to Indigenous businesses that you've kind of noticed?
So for the first part, the main reason that businesses take out loans, it's usually for working capital or to purchase capital assets. So working capital is when you're doing your cash flow projections, industries have different cycles of cash collection and things like that, and they can present times when you might have stress on your liquidity. So you might not have a big enough buffer to be able to weather some of those longer times when you're expecting your invoices to be repaid to you. So one of the first reasons that people do it is to help smooth out that cycle. So if you've got an overdraft facility, it allows you to continue meeting your obligations to your suppliers, to your staff if you've got them, with the expectation that, say, next month the invoices are coming back in and they're getting paid. And that's also that cash flow finance product I mentioned before. So that's the purpose of that too. So that's why we sort of like looking at the as much history as possible, because it allows us to sort of see and model those cash flow cycles, and therefore try and recommend an appropriate limit for your business. On the capital equipment side, that's usually linked to business growth. So going back to that baking example, you might be starting off with a baking product that you're baking at home in your own oven. Pretty soon you're going to need like a commercial kitchen or a commercial oven, so you might need to purchase some equipment there. That's where we might look at either an equipment finance loan, so a loan that's sort of tied specifically to that asset that you're looking to buy, and it has a useful life, so we'll link it so that it's paid off within that useful life and things like that. Or it might be more general, so you might be looking to actually buy the premises to work from. So you might have a term loan a term debt loan, so a loan where you pay principal and interest over time to actually buy the premise you want to work from. So we kind of have solutions that marry up to each use case that you're looking for, but broadly speaking, it's either to help smooth over your cash flow concerns or to allow a period of growth. And the working capital assets, the way you should think about them is the asset I'm buying, is it actually helping me do more, sell more? That's what we're really looking for when you're looking at those things. So the bigger premises means you can employ more people, you've got more room, there's efficiencies of scale associated with that. So that kind of ticks that box. A bigger oven, a better oven, a car, if you currently don't have one, those kinds of assets kind of make sense. That's what that purpose is. In terms of the Indigenous stuff, so the different institutions have, there's a broad relationship of different providers. So I know, for example, I believe that Westpac has a relationship with Many Rivers Microfinance, which I think allows you to borrow up to $20,000 as your starting point. So going back to that day one capital, they do have capacity to lend into that space. Indigenous Business Australia, which members may have had some engagement with, they also have similar sort of startup products, and they also have a grant program as well that can kind of complement that initial lending, and that's really to help you get started. In terms of National Australia Bank, at the moment we don't have anything specifically targeting Indigenous startups, but we do have teams who can help provide. So part of my role is to help understand some of the complex needs that Indigenous businesses might have. So if you're a business that's trying to bid on a large-scale construction contract, for example, for state or federal government, and there's Indigenous procurement policy ramifications around that, part of my role is to help find the right sort of banking team. There's specialists that have expertise in construction services, for example, or who might have experience in more complex deal structuring. So there may be ways for you to attract funding from more than just banks. So there are mezzanine finance providers. So when we look at debt, most big banks you talk to, we talk about senior debt, which means we are the first person that gets repaid in the event of default. That gives us comfort and means we can give you relatively cheap lending. if you require additional funding on top, there are providers that can finance additional money to the business. But because they kind of have the second pecking at covering their costs in the event something goes wrong, they will charge you quite a fair bit more. But that might be great if you've got to quickly grow. Sometimes some of these deals just can't get off the ground, and that happens to non-Indigenous businesses as well. If you've got to quickly grow and your business doesn't have the asset base to support that rapid growth, that might be a way to get around it. And so that's part of my role, is helping our Indigenous businesses connect to those teams, because often they might not be the first port of call. If you call up a business call center or something like that, or walk into a business banking center off the street, some of those bankers don't have experience with those products. So that's why there are roles like mine to help understand those things. Because one thing about the Indigenous business sector is there's a lot of investment, a lot of focus, and a lot of rapid growth. And that's quite different to sort of the organic growth stories you would see in other parts of the economy. So there's a service differential, and then there are some products that specifically target the support of Indigenous business. I believe that Indigenous Business Australia also has like an investment arm potentially that could be looking at supporting the business. That usually kicks in again when you're in that larger growth phase, because they can take quite significant stakes, and they can again help make that sort of structured finance deal a little bit more affordable. So basically you should look at having a primary relationship with a bank, day one, and they provide you transactional services, and they can give you advice over debt products that might be suitable for various stages of growth. There's nothing stopping you talking to other lenders as well. So Indigenous Business Australia have additional products that can go over the top. They don't offer transactional products anyway, so they really only do lending. So I'd strongly encourage you trying to form a relationship with your local agent from IBA as well, so you can understand some of the service offerings. And they run workshops and things like that that can help you understand what they can offer as well. They really do complement the mainstream commercial banks. But yeah, those are probably the main providers. So yeah, for commercial banks, you're more looking at a different service proposition where we can provide additional insight and support to the banking team to make sure you get the best outcome. For IBA and others, they actually do have some additional products that can support you. And then there are some not-for-profit or for-purpose providers like Many Rivers that might have some limited finance products that are really just to help you get off the ground day one, and then they look to transition you to a mainstream lender after that point.
Absolutely, thanks, Adam. I know that we do have a couple more questions that we are planning on getting through, but I am a little bit conscious of time, and we've had plenty of questions that have come through from our members as well. So,
awesome.
What I thought you might do is, we might spend the next 10 to 15 minutes just kind of answering any sort of questions that we've had come through from our viewers today.
No worries.
Which I understand they cover the topics that we want to talk about as well. So the first one is from Gregory, and he says, "Thanks for this warning to all. Adam, you mentioned this morning for a business to get a loan, the bank needs to assess their ability to repay their loan, and a business's plan is part of that. Is it worth seeking professional help to put together the business plan? Will that help with credibility when applying for a loan?"
It can. So one thing I'm mindful of is that there's a lot of providers out there will offer business plan services. But when the bank is assessing your loan application, they're really looking at you and your ability to run the business. So if you're the one operating the business, we're really looking at you. So I think it's always great to get advice and help and support, but you really need to be an active part of that business plan development, and you need to understand it inside and out. The interview experience might not be like we might not grill you, but we are looking at like how believable it is and seeing how you are bringing that to life. And it's worth, again, noting that if it's day one of your business and you've got this really aggressive business plan, it doesn't matter how good that business plan is. It doesn't, like how polished it is. You need some demonstration of track record to help provide additional, especially to a bank finance provider. You might be able to attract other types of investments. So you might be able to get another joint venture partner or another party who believes in your vision to invest at that point in time, but they're actually contributing equity. So they're going to share in the massive upside of your business if it gets off the ground. And they're actually going to have votes or a say in how your business is being run. So they're going to take a different type of risk to what a bank can do. So yeah, no matter how polished that business plan is, if you don't have some element of track record, so even if you just chunk down and just do like a proof of concept to prove that your idea works, it's going to be very hard for a bank to pick it up day one. So I'd strongly recommend trying to build your business plan out, and then maybe seek some support to refine it and improve it. And honestly, if you do engage the right kinds of partners, like a good legal service provider, some of the members, or an accounting service provider, and even a banker, when you initially present these plans, you can actually get quite a lot of feedback from those parties. They won't tell, we can't tell you what you need to do to get a credit loan approved, but we can look at it and say, oh, look, your projections, they look a bit flaky here, and then you might actually have a good answer to that question. But it's that kind of sense checking. And I think the other part is, you've obviously got a community of business partners or business members in your chamber in Victoria. So have a yarn with them and sense check it. Maybe not if they're a competitor or a direct competitor, but there are other people who are looking, have some big business experience and can maybe give you some of that mentorship. I'd go there first before paying like 10 or 15 grand for this really flash business plan. That I think you'd look at doing if you're going to go for like a really big growth story. So if you're looking to do this big acquisition, that's where you can consult with some of like the debt advisory businesses, so they can do due diligence on your behalf. They can kind of sense check your business plan. Those kinds of things where you might be chasing like millions of dollars of cash. That 15 grand is much more valuable there, because they're going to make sure you've ticked all the major boxes that you might stumble upon in that initial application, and they then also have relationships with different financiers as well, and they can help you navigate the process. They're kind of like they can play kind of a role like a mortgage broker, where they can help you find the best fit on the market to resolve what you're doing. Yeah. And there's a growing group of Indigenous owned consultancy firms and business firms, and some of them are tied to the big four like accounting firms as well. You can engage with them, and they will have services that can help you navigate that process. So that'd be my advice. Don't spend it heaps on day one, sure. but if you've got a major growth story, that probably would be where you get the most benefit from it.
Sure. Thanks, Gregory. Our next question is from Tony, and he says, previously at my business, we've been reliant on grants for funding of the business and have been pretty successful when applying for them. Now we are looking for a business loan. Will the fact we've been successful in securing grants when the bank assesses our business loan application?
Yes, in a way. So so we do look at so it's if you're regularly accessing grants, it suggests you might be running like a not-for-profit or at least a for-purpose business, and we do look at those industries a little bit differently to like a purely for-profit business. And so a history of being able to continually attract grants is useful. Again, I think it's the story around that. So why you're able to continue. So if you're spinning up specific project ideas and are just good at repeatedly winning those, that might be less compelling than you've got a core service proposition, like you're actually providing services to the community, and you're demonstrating like a legal services provider or a community health and wellbeing advice provider. If it's a service and you're attracting funding to deliver that service, and you've got a track record of that, that would be looked quite favorably on. I think it's a story around it. So I'd recommend reaching out and having a chat or a yarn with a banker who can actually kind of talk to you about that, because it's a bit hard to answer without knowing a bit more about your business, and I can't do that in this forum anyway. So sorry about that. But at a high level, it's the story of it. It's just like normal revenue. So if you've got, like let's say you had a product that was a flash in the pan, those fidget spinners. If your business was making fidget spinners, there would have been a point in time when you could have made a lot of money from fidget spinners. But if that's all you did, and you kept on coming to the bank asking for more money to make more fidget spinners, most institutions would look at like the market for that and ask you questions about, well, what are you doing next? Like, or do you see this thing going global? Does everyone need one of these? Those are some of the questions that a banker will ask you when they're trying to sense check some of the assumptions in your application. So, to tie it back to that grant thing, if it's provable or demonstrable that there's regular demand and that funding is going to continue, then I think we would be able to look at that quite favorably.
Sure. Thank you, Tony. I am conscious of time, so we'll take two more questions. And the first of these two is from Herb. And he asked, can we take out a blended loan, for example, half fixed and half variable?
You can. So it depends what you're talking about. So when we talk about fixed and variable loans, so fixed rate, usually that we do that for like well, some products are fixed rate by nature. So if you take out an unsecured loan, often there'll be all fixed rate means is that we've agreed a rate that's going to be stuck. We're not changing it over the term of the loan. So credit cards, for example, are often relatively fixed. We do change the rate from time to time, but most of the time you're holding the card, it's fairly stable. For a home loan, you can't fix it for the full term of the loan. You're able to fix it up to 5 years, and they can be blended. For business lending, when we talk about fixing, it's really about what the purpose of it is. So if you want certainty or comfort that the interest rates aren't going to fluctuate on a particular component of the lending that you've got in your business, that is an argument for fixing. But it's and I'd talk more about those purposes rather than asking whether you can or can't fix components of it. So you can, because we can split up your lending needs. So you might have an amount of funding that you need to do a bunch of things. What we try and do when we're assessing your loan is we actually try and break down the individual components of what you're trying to do. So that goes back to what I was saying before. If it's for assets, we want to tie it back to the asset life cycle. If it's for property, we want to make sure that it's got fair market value, and it's a safe kind of element of property to have investments in. And that's where you might get, and then within that component, it might make sense to fix your rate for your property component, for example. But it does depend on what the purpose is. We generally don't recommend fixing for an attractive interest rate, because most people who bet on fixing interest rates lose. So including me on my personal home loan. So it's really about risk mitigation for the business or certainty. Those are the main reasons you look at fixing. But yes, you can fix elements of lending depending on the types of products you're using.
Sure. Thanks, Herb. And the final one for this morning we have from Dylan. And he says, I read the RBA lowered the cash rate and the banks have only passed that onto certain loans like a variable or a fixed loan. Is that right?
Yeah, and I think one of my colleagues might have answered a similar question like this a few weeks ago. So the RBA sets the overnight cash rate. So it's kind of our bank. So when we're settling money between other banks, they hold our money overnight. And it's kind of the floor rate that we can get for deposits. So if they raise that rate, that means the floor, like the minimum we can get paid for deposits, goes up. And so depositors will usually get paid more because we'll start competing with each other to try and attract deposits to our bank, because we need those to fund our lending. And similarly, when it drops down, it'll go down. But interest rates are so low at the moment that linkage has been disconnected somewhat. And so for variable rate, because we still need to pay a margin to our deposit holders, and most deposit holders aren't going to accept like 0.01% interest on their deposit funds. So that's where you're seeing that stickiness in the variable rate. For longer term fixed rates, you are seeing some of the rates come down, and that's because what we do when we offer a fixed rate loan is we try and match up our source of funding to marry up to it. So there are people who are desiring to hold like a 2-year fixed loan and might be willing to accept 1.9% return on that, which means we can offer like 2.08 to a borrower. That's where that fixing comes from. And when you fix a loan, if you want to change it, like if rates continue to drop and you want to break it, that's where you hear like break costs or economic costs. And that's because we literally have to unpick that arrangement from the other side. And so there's a cost associated with it, because the deposit rates would have dropped by that time. So that means that the depositor needs to be compensated for that loss of income. And that usually comes from the borrower. So there's a little bit lost by the bank, but that's kind of the relationship. So it does look really odd when you see the RBA rate dropping, and it's because it's one aspect of our funding mix, and it's not the whole story. And I don't think our industry and I don't think politicians do a particularly good job of painting that picture, because we've got other sources of funding as well. We've got our shareholders who contribute money into our business, and we've also got like international bond markets and things like that are sources of funding. All of those mixed together to establish how much our funds cost. So yeah, it's a bit hard to see, and you'll see some of our CEOs periodically try and speak up about it, but it's not a clear linkage. So it does look odd, and internationally there are rates going negative, and there's some really weird market behavior that happens around there as well. Fingers crossed that doesn't happen here, because we've obviously got pensioners and people who do rely on interest income for their retirement or to meet the cost of living. And having a scenario where you're losing money by holding your money in accounts, that's not a good outcome. So it's a bit of a balancing act, and we tend to focus more on the lending side, but there's a counterparty, which is someone's super fund or someone's pension, or it's coming from those deposit income, and that's been dropping too.
Absolutely. Well, thanks, Dylan, for your question. Thank you, everyone else who submitted their questions today, and a special thank you to Adam for joining us this morning.
Thank you very much. Thanks for having me.
It's a pleasure. We hope you all enjoyed this morning's presentation, and don't forget to keep an eye out for our upcoming webinars. If you do wish to attend, please jump onto the Kinaway website to register your interest. And again, if you wish to catch up on the previous Kinaway TV panel discussions or webinars, jump onto the Kinaway Facebook and YouTube channels, where you'll be able to access them. Until then, don't forget to check out any support services Kinaway has on offer through our website. Fill out the Kinaway Pulse Check survey, and leave a like on today's video, subscribe, and turn on the notifications. Thank you again to all who joined us today, and we'll catch you all soon.